Let's go into China and, more broadly speaking, Asia. Where do you see the Asian, and obviously the biggest economy in that market, second biggest economy in the world is the Chinese economy. Where do you see that sitting for 2016?
The Chinese market, they've certainly got a few key variables that will impact their economy. But in terms of what they're trying to do, it does fit into their long-term plans.
Yep.
In terms of their economy, if we were to put that rating, it certainly is lower than what we would offer the US.
Yep.
Probably the fives, even sub-5, around the fours.
Yep.
Partly because of these key variables that could lead the market any which way in China. The problem or the issues that the Chinese are having, the issues that the Chinese are having trouble with at the moment is this transition from a market export manufacturing economy to a services industry or consumer-based industry.
Yep.
I have been speaking to some clients about this, and I do remind them that with all transitions there will be a lot of volatility, partly because the uncertainty of outcomes.
Yep.
Similar to Australia in the early 80s when we did our devaluation.
Yeah.
And things like that generally will lead to, further down the track, some winners and some losers in that, and it's trying to find where that's going to be positioned.
Yeah, if I could add to that, I mean, what analysts want is consistency and predictability. Obviously, when you get market interference from the government, at the moment, obviously they play around with the currency, and they're also, they've had to interfere in the stock market as well. And that might seem like a good idea at the start, but what actually then happens is no one knows what their next move's going to be. So we've seen them, interject, close markets, put buffers on, cancel stop losses and those types of things in terms of shorting stocks. So it's really important to understand that when we're trying to analyse these types of areas, we want some consistency and some clear direction so we can sort of do our numbers to see whether there's opportunity in those markets. And what we're seeing in China is this transition. I don't think they know in terms of what the best levers are to pull themselves. And so, when the Australian economy, you were saying off air before, when the Australian economy transitioned, to a free market economy, effectively floating the dollar in the early 80s there, we saw the same sort of thing happen until we came out the other side and off we went.
There's always going to be a rebalancing after the fact,
Yep.
once everyone's had a chance to do it. What China has to try and achieve, and last year we touched on the fact that they were issuing their new 5-year plan, which they have sort of come out late last year.
Yep.
I've had a quick chance to go through it, and a lot of it is the same.
Yep.
But 3 key takeouts that I saw that weren't necessarily in the original or the previous 5-year plan was they do have a key focus on internal financial liberalisation.
Yep.
So improving their banking systems and all those types of things internally. There was also a strong focus on international trade and liberalisation of finance. And we can sort of see that with the establishment of the Asia Infrastructure Bank and those types of things, which we are a party to.
Yep.
And the last one that I saw, which was quite interesting, was their policy on the concept of the One Road, One Belt policy, which is essentially they're trying to recreate a 21st century Silk Road.
Yep.
Transportation of goods and services from China to Europe via land and by seaborne.
Yep.
So
Yep.
that's a large infrastructure task that they're going to embark on.
Well, they've got China, Mongolia around
right.
through Russia and into that, as you say, the historical Silk Road when they were. And that's the amazing part about China in terms of they were doing trade with the Romans.
That's right.
So, it's a really exciting time for them. But as the market's seeing, it's a transition time from the heady 9s and 10 GDP numbers down to trying to track to 6 and now sort of hitting headwinds around
Look,
at
and
6
I think
to
that's
7.
one of the key things that we have to take away from that is that obviously a lot of the volatility we saw, which started in August and has continued on, has come off the back of the PMI manufacturing numbers, which is sub 50, and it's been sub 50 for the last few months. Now, if that was the case, if those were the numbers that we were reading in 2010, that was an issue, or even pre that.
Yeah.
But now the manufacturing side of the economy or the composition is certainly lesser than what it used to be.
Yep.
The services component of the GDP in China is now higher, and it's gone above 50%, or just around about 50% of the GDP. So the impact of the manufacturing, whilst still important to the Chinese, it's probably not as significant as it used to be. And that's what we have to get our head around as well. especially, for example, when they were trading at or generating 10% GDP. Their inflations were sitting at around about the 4s and the 5s.
Yeah.
So the real wealth to a Chinese person was still in the 4s and 5s. So whilst they're achieving 6s and 7s, their inflation numbers are around about the 1s and 2s. So it's a more manageable set of data.
Yeah.
The real wealth effect for the Chinese people is still there, but it's certainly a more manageable process.
Yeah, and if we finish off on China, one of the points I'd make there is around the Chinese government trying to retain some of that wealth in the economy. We're seeing the wealthier people potentially investing offshore, trying to get their money out of a technically communist country, and so the Chinese government are trying to stop that from happening. But I mean, if the Chinese government would actually look at sort of giving them reasons to invest back in 1.3 billion people, there's got to be opportunities for that money to find good investment opportunities there, but of course there's this flight of that currency.
Yeah, and we've seen that. I mean, the reason why I say hopefully later in the year we'll see some better sets of numbers and we'll get more clarity, because yes, the government has tried some policy decisions or tools which haven't worked necessarily with the markets.
Yep.
But hopefully over time we will see better decisions made, and one of those things may be cutting back their required reserves and some form of quantitative easing.
Yep.
And we've already started to see that in the growth of the money supply, so the M1 money supply, which is generally a good lead indicator for economic activity. The question is, hopefully it doesn't all end up in the property market.
Correct, because we don't want property bubbles.
That's right.
And I think the other, again, you've sort of...
Chinese property market.
Yeah, that is. It's not obviously the Australian property market. In terms of the challenge they've got around lowering interest rates is also how that impacts on the dollar. So, from that point of view, that's their exports, that's as they're trying to transition. So they've got a few challenges, and that's, again, why I suppose you've wrapped them up as a 4 to 5, but they'll come out the other side.
There are 4 to 5 because of the variabilities there, but just bearing in mind that, because I think the key issue with China is that people, there's two sides of the camps really. There's the hard landing camp and the not hard landing camp, I guess. I'm a subscriber to the latter, not the former, partly because of the fact that they do have quite a bit of ammunition up their sleeve.
Yeah, they've got a bit of a war chest.
They have the $3.5 trillion in foreign reserves.
Yeah.
I know that some people have quoted the fact that the Chinese debt levels have gone up to 240%.
Yep.
But keeping in mind that that is total debt, the government and the private homes or household debt is still relatively low, as in sub 50.
Yeah.
And to put that into perspective, the US total debt is around about 330% to GDP.
Yeah.
Okay.
And I think that look, I think everyone wants a soft landing because the world can't afford, in its precarious geared position that it is in, not to have that soft landing, and they'll do everything they can. The sort of fiscal and monetary policy makers around the world are going to try their best to not have that hard landing, because that will have a flow-on effect to other economies.
Yeah, look, and in their 5-year plan, they've put it out there that the next 5 years they're targeting a 6.5 growth.
Yep.
The previous 5 year they targeted 7. Again, very good numbers to come in at 6.9.
Well, that's compounding numbers too.
That's right.
We can't forget that. It's pretty big.
And I think if the Chinese can still maintain, even if they come a little under at the 6 mark, that would still be supportive of global growth.
Yep.
I think
and improve living standards for the local people, which is really important.
A hard landing scenario would be if they went sub 5.
Yeah.
That would be a concern.
Yeah, okay. Let's jump into Japan, one of Australia's biggest trading partners. Where do you see the Japan economy?
Look, Japan, interestingly, late last year they had a very quick or flash recession.
Yep.
They've been doing quantitative easing for some time.
Yep.
Japan's quite a different kettle of fish to China. They've been in a downward spiral, deflationary position for quite some time.
Deflationary for a while. Yeah.
So they are trying to get themselves out of that. And recently they just announced the negative interest rates. And that is in part for them, or they're trying to drive or get inflation up, which is some activity in their economy.
And getting so just to explain that, what they did was they didn't make it a blanket negative interest rate. They've said those cash reserves are fine, but any spare cash reserves that you got with us, we don't want. get it out into the economy, start lending that money, start stimulating growth, start stimulating jobs, and move us into a positive GDP environment. Yep. Quick comment on India. Do you see that as an emerging market economy?
Oh, look, it is an emerging market economy, and in some respects, we're all hoping that they certainly pick up some of the slack that the Chinese have dropped off.
Yep.
Again, India.
Cost of labour story is going to be a fairly good one.
Yeah, that's right. They've got the key demographics. They've got the position from where they can certainly go forward.
Yep.
And some commentary and even myself that I subscribe to, I think India is probably where China was pre-2000, just pre-2000 in there. So, but again, they
15, 20 years behind.
Yeah, they need the I guess the government and the policymakers behind it, and to actually execute and implement.
Correct, and I know that as a non-communist country, it's hard to get that firm change.
That's right.
Oh, we need a freeway through here. Let's knock all those things down.
Right.
That doesn't quite work in India.
That's right.
As like it does in China. So that's
but there is certainly a strong growing middle class in India, and it's the same as in China. That's what we're looking at the moment. So.
Yeah, and I think their education levels are increasing, and the opportunities in the new age economies and innovation technology economies. I think there's some exciting times for those two nations ahead. Let's have a quick look at Europe. Where do you see Europe?
Europe has benefited from the quantitative easing. Again, like the rest of the world, inflation numbers are a little bit low. But we are seeing an improvement in their business activities and also the manufacturing. In fact, the PMI numbers globally, I think Europe's got the strongest. They're sitting at around about 56 as I think Germany, that is, I was referring to, which I use as a general benchmark. They were sitting at the 56 points to the December quarter. So the quantitative easing is working there. And in terms of valuations, it's probably an attractive valuation there.
From equities point of view?
From an equities perspective, relative to where the US is trading at the 18 bench PEs.
Yep.
But again, Europe still has a few headwinds in the next year or two, possibly.
The general EU whole sort of structure staying together. And
yes, that's right, because previously we had the Brexit concerns mid last year. I think this year and possibly next year we have the bigger and more realistic probability of the UK or Brexit, I think they're calling it. So the UK actually potentially leaving if they're not satisfied with the terms of the EU.
Yep. So. Okay. UK economy quickly.
Look, they've been doing really well. They probably want to be the stronger players in there.
In Europe,
and even Europe as a whole with regards to some of those pigs that we've sort of forgotten to talk about them over the last few years.
Explain to the viewers what the pigs are.
Portugal, India,
Greece.
Sorry, it's Portugal, Italy, Ireland, and Greece. These countries that had a lot of the issues during coming out of the GFC. And if you look at the Irish economy, again, they've started to pick up. Their manufacturing started to pick up as well.
Okay.
And they've been doing really well, with the exception of possibly Greece.
Okay. So now let's come...